Okay, it's 11:03 Pacific, 1:03 here in Chicago. Thank you very much for joining the Beacon Pointe Macro and Markets Quarterly Update. I'm Michael Dow, the Chief Investment Officer. There's a lot of material we want to cover today. There's a lot to talk about, so let's jump right in. So we have an agenda. Oh, before we go to the agenda, let's see if there's any folks that are having difficulty navigating the webinar functionalities. There's a Q&A that's available at the conclusion, but you can submit a question on Q&A at any time. Also, if you want to see the speaker view here, you can go gallery, or I'm sharing the screen. So whatever you're most comfortable with. Let's jump into the agenda. We're going to start with a pandemic update and the reopening. It's the most important thing when trying to determine where the capital markets are headed. Are we on a linear path, or are we on something more like a W? Policy and politics is taking up a lot of time on the airwaves, and it's of great importance to our clients. So we'll talk about the policy response to the Great Lockdown and how politics intertwines with the outlook for policy. And we'll get into some recent developments in stock and bond markets. And finally, the theme of the age is financial repression. That is, there are certain things that we see at Beacon Pointe that look likely to have significant and lasting effects on financial assets, particularly interest rates, over the course of at least several quarters, at least the intermediate term, and perhaps much longer. And we dub those effects financial repression. More on that later in the webinar. When we presented in May, I suggested that a potential game plan for the pandemic might be, first things first, we have to mitigate the virus. And as you're bending the curve, you want to keep an eye on the economic damage and make sure you're toting up the government's mitigation efforts and netting those two. So bend the curve, see what the damage has been, and then see what the fiscal and monetary policy response has been, and that's your net effect. In the meantime, and you have to make sure that the capital markets are working. So the equity market needed some support. How did the equity market get support? By fixing the bond market. So the first thing the Fed did was to ease credit conditions and reduce equity market volatility by supplying nearly unlimited liquidity to the marketplace. That caused a reduction in equity market volatility, and the stock market responded very positively. So check, job done. What could derail the recent asset price recovery? Well, sentiment is the key. It doesn't look to me that there's a lot of fundamental basis for the current stock market levels. That is, if traditionally we're looking out 4 quarters, that doesn't quite do it from a valuation perspective, and we'll talk about the details of that in the webinar. If we get a setback or an increase in a spike in the virus, additional hotspots, et cetera, that is going to be a problem. If we get higher than expected corporate defaults, the Fed's doing what they can to support the markets, but if it's not enough and default rates increase, then that will be troublesome for corporate profit. So all of these things really rely on the reopening occurring on in a regular format and in a linear fashion. And that's all dependent on consumer behavior. So it really comes down to the consumer. No matter what the governors or the local authorities say about reopening, if people aren't comfortable getting on an airplane or going on a train or eating out at restaurants, then we're not going to have an economic recovery. So that goes back to bending the curve and identifying treatments and a vaccine. And when that will arrive with any degree of the quantities necessary to create the herd immunity needed to get folks comfortable with going out and about again, difficult to say. The best case scenario is later this year. The more likely case, which usually takes 5 or 10 years to get a vaccine out in size and fully tested, should be sometime this time next year before we're really seeing, I think, some substantial progress on herd immunity. We'll have a vaccine before then, but to get it into people's systems and to create the antibodies, it's going to take a while. Markets focusing on the 3 Ps, the pandemic, policy, and those are the macro pieces, and then prices, which is another way of saying valuation, and that's the market. So pandemic, policy, and prices. In policy, there's a nuance. The policy nuance is politics. We have an election 89 days from now. It could result in a change in the administration. No way to separate policy and politics. The persistence of any monetary or fiscal policy is in large part inextricably related to who's in charge in the House and in the Senate and who's signing or vetoing bills in the White House. So politics and policy are fellow travelers. There's no way to separate the two. In 2021, the thesis is we're either going to have a business-friendly policy administration or we're not. And that is what a lot of folks are talking about, the implications for the election. So we're going to dig into the election pretty meaningfully. If we get a divided government, that's generally best. Divided meaning the White House, the Senate, and the House are not all held by the same party. First, let's talk about the pandemic and see if we can't draw some conclusions about where we're headed as a country. We look at cases, hospitalizations, patients in the ICU, and then patients on ventilators to see whether or not the current outlook and what's happening in the local healthcare infrastructure is either acceptable or it's stressing the limits of the resources of the local hospitals. And that's why hospitalizations to me is the most important thing. It's also the leading indicator. You go cases, then if you have a case that needs hospitalization gets worse, you go to the ICU. If you're in the ICU, you have capacity to be on a ventilator. So keeping track of hospitalizations is really incredibly important. It's a leading indicator. And it looks, the news there is good. The headlines are bad, but the overall data seems to be improving, so that's a positive. So let's talk about the states that are opening and who are not opening. And to start with, where are new cases growing and not? Right now, here in the Midwest is really more of a hotspot than other areas. So Minnesota, Iowa, Illinois, Kentucky. Wisconsin's cases are shrinking now, but really it used to be a coastal problem 2 months ago. Now it's got us here in the Midwest. And who is reopening? The blue is reopened, and if you're tan, the darker tan color is you're reversing. And the data support that. You had reopenings in May and June in places like California, Texas, Florida, and Arizona, and the cases then grew, and now you're reversing. There's a cause and effect, no question about it. In terms of the consumer behavior, it's really what's driving it. So I'm looking at hospitalizations, and we're looking at how comfortable people are going out, and with the reopening. Again, it's not if the local authorities are dictating that things should be open or not, it's whether or not people are actually going to go out of their house and spend. So consumer behavior is the key. So here are the trends in reopening. Restrictions easing are blue. Reopening paused is yellow. So restrictions easing and lifted. They completely lifted in Missouri and Wisconsin, apparently, and Alaska. The restrictions are easing in the Northeast. They were easing in the Midwest, but now that we've seen a spike in cases, that may change. And restrictions have been are tightening again in the 4 hotspot southern states: California, Arizona, Texas, and Florida. So it's not a linear process. It's not like we can just decide we're going to reopen the economy. Although I do think that positive linearity, which is something that market participants are talking about, positive linearity is in large part due to where the stock market's trading right now. Linearity means either in terms of economic opening and corporate profit recovery, that it's going to be a straight line. We're going to go right from point A to point B with nothing in between, or point C with no B, and B might be up or down. My view is it's not going to be quite as straightforward as all of that. Quick look at the global economic activity here. What these are is global purchasing managers indices. They're great real-time indicators of economic activity globally on the top, and China and the US on the bottom. If it's above the red line, global economic activity is expanding. If it's below, it's contracting. And clearly, March, April, huge contractions in the great lockdown, both here in the US, first in China, then here in the US and globally, in primarily services as opposed to manufacturing, and that makes sense. Services are face-to-face businesses, and all of those got crushed. Unprecedented, just never seen anything quite like this. The rebound is due in large part to the depth of the decline, something called a base effect. If you go down a lot, it's easier to come back, to snap back quite a bit. That's called a base effect. And it makes it hard to accurately understand where the true trend direction is, even if you see a snapback like this. Digging into the US activity, we're back to expansion with the reopenings. Whether we persist on this upward trajectory of higher and better economic activity, or whether it kind of flattens out, or maybe it's really sort of like we have a dip and some states are reclosing and pausing on the reopening. Might get a dip in economic activity, something more like a W as opposed to the V-shaped recovery that we've seen to date. How bad was the Great Lockdown? Well, US GDP and unemployment going back 70 years is what we're seeing. GDP on the left, unemployment on the right. 1947 until March, or now June, the June print for GDP, which was down almost 33%. You never saw anything like that in our economic history since data records have been kept. Now, if you look back and you can piece together other data during the 1920s and 30s, which actually makes the second quarter of 2020 only the fifth worst, but you have to go all the way back to the 20s and 30s. Clearly, in the last 70 years, this is by far and away the worst. And next quarter, the third quarter, we expect a 25% print. And then something more like a W here coming back in the fourth quarter of this year and first and second quarters of the following in 2021. So that's GDP. GDP has had just an absolute roller coaster ride. Same with unemployment. These are staggering losses in jobs. 14.7% in unemployment rate. We're at 11.1 now, probably going to get to 6.5, but this is a very long series. It's going to take 2 or 3 years at least. But the feeling is that second quarter 2020 should be the bottom in the devastating loss in both output and employment that we saw in the Great Lockdown. So here's the high frequency data. We can look back 70 years and see where we've been, but to know where we're going, it's important to look at high frequency economic data. And we're looking at restaurant bookings, airport activity, jobless claims, and New York subway mobility. And this is data as of the beginning of this week. What we're seeing is about 50% capacity down from, call it 60% capacity. That is, if you're down 40% year on year in restaurant bookings, you're at 60% capacity. We got back to a pretty good number, but then with the pause in the reopenings, restaurant bookings have started to plateau. And so we reached a bit of a peak there, probably around 4th of July. And in the month of July, we've settled back towards about half capacity in restaurants. In terms of airport activity, 26% of capacity. These are the number of travelers going through TSA in 2020. These are the 2019 in the orange, 2020 is in the green. And this is just the ratio. So we got to a peak of about a little over a 1/3 capacity, again, around 4th of July, but we're settling back towards 26% capacity. So the high frequency data is showing a bit of a peak after the euphoria of some reopenings in May and into June, but now a bit of a turnaround. Initial jobless claims, very high frequency data in the labor market. There's actually a better print that came out today that was closer to 1.1 million. So this number does seem to be improving, and that's positive. But we have a long way to go before we get back to New York activity, mobility data here on the New York subway. These are turnstile entries in the MTA at 7 million, and they were at 34 million at the end of February. So we're well below. We're 20% of the capacity of the New York subway system right now. So we are way, way far away from being back to full. Monetary policy has been the savior and has been the hero so far, along with the healthcare professionals who are on the front lines and our first responders. This is the first responder to the economy, and Jay Powell and the Federal Reserve Board have done a spectacular job by cutting rates to zero, expanding the balance sheet massively, and opening up what we're calling the alphabet soup of lending facilities that has been so beneficial in reducing volatility, reducing the likelihood of bankruptcies, reducing the chances for the stock market to fall off a cliff or stay off the cliff. So all of these things, especially the lending facilities, have been very beneficial in reducing equity volatility and getting the stock market back on its feet. And the good news is that that's the cavalry. They're the first to arrive. They've saved the day. They arrived in March. They continue to run to the rescue. And the Fed is still prepared to use all of its full range of tools, which, by the way, is a printing press and unlimited paper and ink, to support the flow of credit. In fact, they just announced last week that they're going to extend the lending facilities that were scheduled to expire in September, but the Fed's going to extend lending facilities until the end of the year. Here's been the primary source, the first line of defense, and the unfettered balance sheet. You don't need any approval besides the FOMC's AOK to start printing money. And the Fed did so instantaneously back in March, and they're still printing. We're at almost 7 trillion in debt. And by the way, this orange line, this goes back to 2010, by the way. This is the Fed's assets in the balance sheet. This is growing assets in the balance sheet. And this is the stock market. So growing assets in the balance sheet means increasing the money supply. And by increasing the money supply, that liquidity has to go somewhere. And in many cases, it goes to the stock market. So you would expect the same. If the stock market, if the Fed's increasing the size of its balance sheet, all else equal, it's likely that the stock market is likely to go up. We're at 7 trillion now. Even just the announced quantitative easing and other measures that we expect in coming months are likely to take the Fed to $9 trillion, which, by the way, is about 40% of GDP. We can do this. We can do this because, as the United States, we own the reserve currency of the world. It gives us extra degrees of freedom to print money because there's built-in demand for US dollars. All global commodity transactions are a good measure of them, and 60 or 70% of reserves in other central banks are held in US dollar. That's built-in demand for US dollars. You have to exchange into dollars to trade oil. Even if you're, Saudi Arabia to China, you need dollars. And as a result, that's the definition of a reserve currency. It's a global store of value, and it's used for global financial transactions. We're the reserve currency, so we get some benefits from that. But still, this is a lot of money printing, and as I said, it's approaching 40% of GDP. The monetary policy authorities and the Fed haven't been the only ones who have been helping to try and mitigate. What we have here is the fiscal mitigation effort. So the fiscal mitigation effort is pretty straightforward. You had phase one, 8.3 billion back in March. You had phase two, 100 billion on March 18th, and then the CARES Act was published and came out March 25th, the 2.2 trillion. We need more. There was a top up a month later, call it phase 3.5. But what we're really talking about today, and what's being debated in Washington D.C., is phase four, which could be 1 to 2 trillion, dependent on the economy and frankly on politics. It's been an unprecedented fiscal response, and our reserve currency status also gives us the ability to spend money more so than anybody else. We can print more money and we can spend more money because we can issue more debt. So it just gives us more degrees of freedom on the fiscal policy front as well. What's going to be in phase four could be, again, 1 to 2 trillion. Most of the relief measures, the CARES Act, have expired, especially the enhanced unemployment benefits. They expired last Friday. And there was a ban on evictions from federal housing programs that expired on July 25th. So without an extension to the federal housing program extension, eviction extension, you're not going to, people can start to be evicted on August 24th. So we should, and given that the unemployment benefits have expired already, although if we get a deal, and I expect a deal soon, that it'll be retroactive, that still you need money now. So we're bumping right up against, and we'll soon go over the income cliff when those unemployment insurance benefits are not forthcoming. So what's going to be in it? We're $1,200, another $1,200 check, or $2,400 for married filing jointly based on certain criteria. The unemployment insurance boost will return. It was the first thought was maybe it was going to be between 200 and 400, but as we get further down the path and increasing pressure on lawmakers, should be between 400 and 600, and some kind of housing relief, and probably not a payroll tax cut. And a liability shield is the third rail in the Senate that they're trying. The Republican Senate is trying to get done, so that's a real maybe. The Senate goes on recess after tomorrow's session for a month. They don't come back until Labor Day. They can, of course, postpone it, and they will. There's no reason why they wouldn't do a deal. It sounds bad right now, and there's a little negotiating going on through the television as McConnell and Pelosi talk to each other that way. But the pessimism, I think, is really negotiating tactics. A deal is imminent. It has to come before they go on recess. And in fact, if, as was happening earlier this morning, if the market riots, it's actually back up now about 50 basis points. But if there's a market riot, then there will be a compromise. All parties will come together. If the stock market sells off, it'll be a referendum on not getting anything done, and the riskiness of getting to where we are without providing additional income support to workers. So is $4.5 trillion going to be enough? The answer is, I don't know. If it isn't, there'll be more because we're the reserve currency of the world. Total nominal GDP is 19.4 trillion. So 4.5 trillion in that context is about, well, 3 trillion is what we've got so far. That's passed and done, hasn't all been spent, but we're looking at adding another 1.5, it'll get us to the 4.5. 4.5 trillion is almost 100% of 1 quarter's GDP, which is amazing. So it's a lot. It's a lot of support from a fiscal perspective, and it's probably not going to be enough. We're going to have to do a little more if we don't get a linear reopening of the economy. Here's our major economic forecasts. We're looking for more of a W economic recovery. That's GDP upper left. Inflation lower than the consensus. Unemployment rate bouncing in the fourth quarter because of pause and reopening. And the Fed funds rate is going to be on hold forever. So let's now talk about politics, because policy and politics are inextricably linked. As it stands in the betting markets, the national betting markets, which is more of a nationwide polling effort, as opposed to what you need to do, which is go state by state and see who's going to win the Electoral College, which we do on the next slide. But right now, the betting markets are suggesting 59% likelihood of a Biden victory, 42% for Trump. But we are way far away from November 3rd. There is a lot that's going to happen between now and the election, not least of which are 3 presidential debates coming up in the 6 weeks prior. And you're seeing some compression apparent here. There was a spike in support for Biden starting in June, which now seems to be plateauing. But again, it's not about national polling. It's about what states you can win in order to get to 270. If you don't get to 270 Electoral College votes, it doesn't matter if you win the popular vote. So right now, based on an assessment at 270.com, which is one of my favorite websites for political info, the presidential election is leaning Democratic. That is, as it stands right now, if the polls are correct, everything would, and everything went this way, you would still have 91 votes in toss-up, but you had Georgia and Ohio move into the toss-up category since June 30th from lean Republican. It was a total toss-up 30 days ago, but now it's lean Democratic. What's the pathway to victory for the Republican, the incumbent administration right now? It goes, every single pathway to victory goes through Florida. So if the Republicans don't hold Florida, and just see where Florida is. Florida's a toss-up right now. If the Republicans can't keep Florida, they won Florida by a spare margin in 2016, then it's pretty much over. So that's that is the presidential combinations for victory that you need to focus on. The popular vote doesn't matter. It's about which states, and these are the only combos that work. That's for the presidential election. Let's talk about the House and the Senate. Currently, the House has 232 Democrats and 198 Republicans. The Dems maybe are going to lose, a few. Maybe they'll gain a few. But when it's all said and done, we've only seen a little bit of change. Dems up 1, Republicans down 1. The forecast for when it's all said and done is that currently that there's 19 toss-ups. The Democrats are likely to retain control of the House. They would have to lose all of the toss-ups and a few of the lean Democratic to get down to 218 House members, which is the number you need for a majority. So 224 seem safe versus 192 for the Republicans. So it's more likely that the House stays in Democratic hands. The more interesting races have moved to the Senate, and things have kind of shifted there. Senate currently has a Republican majority, 53-47, and 2 independents, but the 2 independents caucus with the Democrats, so it's effectively 53-49. That doesn't add up to 100. So 51 plus 240. Okay, so right now there's 2 vacant seats. That's what it is. So you've got Senate membership on the bottom left, and then here's who's running and where. And the numbers are actually in the Democrats' favor. Current makeup is actually Democrats at 45, not 47, plus 2 independents. So the Dems are 45, independents 2, Republicans 53. There's 33 seats and 2 vacancies that are going to be decided on November 3rd in the Senate. Those are up on the right. Most of them are red. 23 of the seats that are up for election in the Senate are Republican. So the numbers stack up for the Democrats in this, potentially in the Senate. So here's what we have. Currently, it's a toss-up, which is a change. Again, the Republicans have a 3-seat majority in the Senate right now, but there's been some change in the polling, and the consensus outlook now is Republicans down 3, Dems up 1, and the toss-ups increased by 2. Montana, Iowa, Georgia went from lean Republican to toss-up, and Arizona went from a toss-up to lean Dem. So this is what we're looking at to see who's going to control the Senate. And this is really important. Who controls the Senate can be impactful, or it might not be impactful, and let's talk about that. By the way, the coattails work here. So what we've seen is as President Trump's approval ratings improve, then the Senate races seem to tilt towards Republican candidates and vice versa. So aspirations in the Senate are linked to Donald Trump's approval ratings. So this is a quick civics lesson because it's really, really important. Doesn't matter if you get a Democratic sweep for markets and for the economy. And it's not as much as you think. You need 60 seats in the Senate to pass most legislation. A bill can only become law if both the Senate and the House pass it, and of course the president signs it. The Senate has a particular rule different from the House that allows its members to debate a measure for as long as they want. You can only vote on a bill in the Senate or in the House when debate is ended. There's only one way to move a bill from debate to vote, and that is to invoke Rule 22 of the Senate, which is the cloture rule. It says we're going to end the debate and we're going to end the filibuster. We're going to move to a vote. If you can't bring the debate to a close, you can't vote on it. If you can't vote on it, then the bill dies in the Senate. It's the only formal procedure for getting a vote done in the Senate. So as a practical matter, you need, the only way to achieve passage of any party's priorities, frankly, is to have a filibuster-proof 60-seat majority in the Senate. A simple majority doesn't get the job done. That's I don't know if this is maybe difficult, but a simple majority doesn't do it. You need 60 seats in the Senate to have unfettered policy priority, a pathway to getting your legislation done. And there's really very limited scope. There's a couple ways, maybe the Democrats pick up 3 or 4 seats and get to a majority and you get a unified government, but it's very, very, very difficult to see how the Democrats can get 60 seats in the Senate. Let's move on to markets now, because this is key. Okay, in terms of the stock market, what we've got here is the fastest bull to bear to bull market in history. We dropped 34% from February 19th to March 23rd. We're back up almost 50%. You need a little more. The math just says if you need, if you're down 35%, you need to be up 51% to get back to where you were. We're almost there. We're almost there. Consensus 2020 earnings, by the way, is $125. The stock market is trading at 26.6 times that number. That's pretty high. That's 10 round lots. That's 10 turns above the 16 times 25-year average. So 26.6 is pretty expensive. So the stock market's doing something here. It's looking through. So what is it looking through to? Let's take a look at some S&P 500 earnings estimates. So 2021 is looking at 163. So now we're out of 2020 and we're moving into 2021. That only gets you to 20.4 times. If you think we're going to be back to 163 on earnings, that makes for a 20.4 times at our current, this is as of yesterday's close, 33.28. Maybe the market is looking through further to 2022, and we're talking about $186 of earnings. If so, then we're trading at a more reasonable 17.9 times. It's always been our contention the market was going to look past the short-term damage to corporate earnings, but to be looking out this far doesn't give me a lot of faith and confidence in the foundations of this marketplace. It's more sentiment driven than fundamental, because the fundamentals are so far out in the future. So the stock market's trading on something. It's trading on the Fed and positive linearity, which is the ability to go from point A to point C and have point B be positive. So positive linearity in the Fed is what's driving the stock market at this point. Why is the stock market trading here? I'll just say because the economy is reopening. We made good progress on the virus. Now that seems to be reversing. Maybe there's something to do with the day traders, potentially. There's a lot of stories about Robinhood out there. But really, it's more about the Fed. Having the Fed rescue the bond market was, to me, the proximate cause of why the stock market's trading where it is. Save the bond market, saves bankruptcies, equity holders aren't wiped out, equity market goes up. But if you do think that if that's not impactful or that hasn't been a big deal, here's the rally we've seen since March 20th in various credit markets. This is what the Fed did with the 3.5, almost 4 trillion of additional liquidity that it's supplied to the marketplace since early March. global fixed income markets. In high yield, you can still get 5.3% yield. And in the last 3.5 months, high yield has rallied 5.5%. So you could have bought high yield at 10.5% 3 months ago. So these are various credit markets that the Fed has fixed effectively, both domestic and emerging and outside the US, and municipal bonds and core bonds and treasuries and everything else. They fixed it all with the liquidity provision vehicles. And this is just the rally. If defaults were to rise, if the high yield bond market or the investment grade corporate bond market was non-functional and it caused bankruptcies and defaults to increase, the stock market doesn't go anywhere. So you fix the credit market and the stock market responds. So again, day traders, maybe, I don't know. I'll just leave you with this thought. Before some loan information was announced about Kodak, by the way, the Hertz was the darling of the day traders 45 days ago. That's another very interesting story. Kodak, on the other hand, there was only 9,300 Robinhood investors holding Kodak before some news was announced. After the news was announced, 72,000 folks held it, and the stock was up 1,500%. This just seems very bad, difficult, to understand, and not quite sure what it means. But it doesn't mean that potentially there's not a strong foundation. The Fed is a strong foundation for where the market currently trades, but individual stocks that go up 1,500%, that's not a strong foundation. So again, just to make sure this theme is brought home in as many different ways as possible, investment grade and corporate bond spreads. So you had major stresses during the great financial crisis. You had very stressed credit markets in the immediate aftermath of the lockdown, but it was immediately addressed by the Federal Reserve. The Fed came in, and BBB rated investment grade corporate bond spreads came in very quickly. They never got as wide as they did during the great financial crisis, either in BBB or on the right side, you've got high yield bond spreads. So opportunities remain. Buy what the Fed is buying. The Fed is buying investment grade corporate bonds, and it's supporting the high yield market. So opportunities remain in credit, not much value in government debt, especially if you look at it on a real yield basis, which we'll talk about in a second. Same story for municipal bonds. There was a great recovery in non-investment grade, not as much, but in investment grade municipal bond yields, they're back to where they were. Looking at the chart on the right and the red dotted line versus the blue. The blue is the spreads on municipal yields, or municipal yields spiked in March and April, but they're back and now below where they were in February, whereas high yield municipal bond yields remain elevated. They're about halfway back, but the opportunity in high yield municipal bonds remains, and they're higher than, and they haven't seen the recovery as investment grade has, in large part because of the debate that's going on in Washington, D.C. right now about how much state and local support to include in the next stimulus bill, which hopefully will get done either over the weekend, if not tomorrow, over the weekend, and early next week, signed by the president. Okay, Treasury yields. This is 230 years of Treasury yield data. So 10-year Treasuries have averaged almost 5% for 230 years. But looking at the chart on the right, we're down to 55 basis points. That's 1/10 of the 230-year average. We're at multi-century lows in interest rates. This is important. This is really, really, really important. There's some questions on the Q&A about Fed money printing, about gold and silver. We're going to get right to that. Hold that thought, because everything that I'm talking about as it relates to interest rates and inflation will directly relate to the answers to these questions. So nominal, these are nominal yields. Nominal interest rates are at multi-century lows. Inflation expectations, which have been very low and subdued ever since the great financial crisis. Here we have inflation expectations and actual realized inflation through a PCE core deflator. That's the green line. Inflation expectations is the blue line. Looking at the long-term data on the left, but the more recent data, 18 months of data on the right, same series. Inflation expectations since March have moved up materially, whereas realized inflation, that's the green line, has yet to pop. So actual prices haven't yet. This is actual prices you would see for core goods, so not food and energy, remain at about an average of 1%, whereas expectations for inflation priced into capital markets are closer to 1.5% for the next 5 years, up from almost zero just 4 months ago. So inflation expectations are rising and are back to where they were before all the money printing began in March and April. So this is a trend that can persist because the things that drive inflation, which you're not going to see until the economy recovers because there's no bottlenecks yet to actually cause the pressures that would result in higher prices in an economy that's working at, well below capacity. Once the economy recovers, then all of the money that's being printed right now needs to find a home eventually. Right now it's being stored in excess reserves in the commercial banking system, but once it starts getting out into the economy, it should put upward pressure on prices, and we should see higher inflation. So lower nominal yields, higher inflation, there's consequences for that. So let's talk about it. What those two things together mean, by the way, is real yields, and real yields have collapsed. Having negative real yields is a real problem. Negative interest rates is the function of multi-century low nominal yields and rising inflation expectations. It is the story. Negative interest rates, negative real yields is the story of the next cycle. And I'll explain why I think there is a strong body of evidence to suggest, both historical and current, and soon to be current, come the September FOMC meeting, to suggest that these two factors, low nominal interest rates and higher inflation, to produce negative interest rates is really the operating framework that we're going to be living under, something we've dubbed, not me, it's called financial repression. Repressing nominal interest rates and letting inflation run hot is a way to liquidate the debt level that we've seen. So let me get to that. Lower for longer, these are forward curves for both 3-month treasuries and 10-year treasuries. It basically says that there's no expectation the Fed's going to raise interest rates until 2023. And when we get to 2022, my feeling is that will be pushed out another 2 or 3 years. The market's forecasting only 120 on 10-year notes in 2023. I also feel like both of these curves are likely to be shifted out. That is, as we get out to 2022, 2023, and the market reevaluates, it's going to be lower for longer. So, and Jay Powell has said at his last press conference after the FOMC meeting a week ago, he's not even thinking about raising interest rates at this point when asked a question about when are they going to raise interest rates. So he said not thinking about thinking. It was extraordinary. They're nowhere near raising interest rates. So lower for longer is the outlook for nominal interest rates. The reasons for historically low rates, lower potential GDP, our reserve currency status, and of course the Federal Reserve's buying up everything. The Federal Reserve, QE, lower growth and inflation, uncertainty and flight to quality, all of these things argue for lower interest rates. Potential GDP lower argues for a lower neutral real rate and foreign demand for our assets. That's just being the reserve currency. We do have the highest monetary and fiscal policy degrees of freedom. So there's a lot of questions about not being able to print money forever, and maybe there's going to be a full collapse of the system. No. The reserve currency of the world is the thing that is our armor. It's the shield that we have that allows us to print money and to issue debt. And you don't lose that until there's a reasonable replacement. It's a relative game. It's not just you're the reserve currency or you're not. You either have the deepest, most safest, most liquid capital markets and a currency that's not subject to emerging market-like volatility because of a financial imbalance and inflation. It's actually a self-fulfilling prophecy. If you're the reserve currency, it's much less likely that you're going to have a currency problem. And a currency problem is what basically is the proximate cause of losing your reserve currency status. The reserve currency, of course, before the U.S. was the pound sterling out of the UK, and the transition wasn't seamless. It took many years, and it will take years again. We're not going to be the reserve currency forever, but we are going to be the reserve currency right up until a reasonable substitute makes its appearance known. And there is no reasonable substitute. The euro is making a bid to increase its reserve, the euro's proportion of reserves in global central banks. The renminbi, the People's Bank of China, is making a bid to use yuan and in international commodity transactions. These things are chipping away at our reserve currency status, but there is there's no reasonable substitute right now. So we will continue to be the reserve currency of the world, even with all this money printing. As long as we can get a hold of the debt levels and do what we need to do to reduce them over the course of the next 10 or 20 years, which, by the way, brings me to financial repression. What are the long-term implications of all of this stimulus response? Clearly, higher debts and deficits. You can't print money and issue debt without increasing the budget deficit. The budget deficit in 2020 is likely to be on the order of 18%. Debt to GDP in the United States was less than 90 before this all started. It's about 106 now. 106% of debt. We have 106% of debt to GDP. So if GDP is 20 trillion, right now we have 21 trillion plus or minus in national debt. So having more debt than the income is not a horrible thing. Other countries can do it. We can do it. But it is the highest level we've seen in a very long time. And I'll show you exactly how high it is historically in a second. But if you have higher debts and deficits, you're probably going to have to raise taxes at some point. And you need to keep nominal interest rates low, or else your debt service gets out of hand. And you can increase inflation, because if inflation is higher now and you're paying back the debt 10 years from now with inflated dollars, the real amount of the debt, the nominal value of the debt doesn't change, but the real value is liquidated over time because you're paying it back with inflated dollars. And that's key. Having inflation run a little bit higher than your target is absolutely essential to our thesis related to financial repression. Putting those two things together, by the way, nominal interest rates at a very low level and higher inflation, again, gets you to negative real interest rates. Make no mistake, it was absolutely necessary to do what we did. You fix if the house is on fire, you pour water on it first, and then you worry about the water damage later. And as it stands, the economic damage to the economy was absolutely unprecedented, and it was nobody's fault, to the extent that the great financial crisis you might be able to blame on over-levered financial system and a originate to distribute model in residential mortgage lending that led to poor incentives. So you could blame the banks in 2008. There's no blaming anybody for the pandemic at this point. Just fix the problem, print money, issue debt, worry about the water damage later. Okay, so these are the numbers. This is budget surplus deficit as a percent of GDP. Phil Swagel at the CBOE, at the Congressional Budget Office, suggests that in 2020, the budget deficit is going to be almost 18%. And this is data that goes back to the 1930s. The last time we had a budget deficit, anything over 10%, was back during the war years, when of course you were going to issue a lot of debt, and you were going to spend a lot of money to fund the war effort. So back in 1940, 42, 43, budget deficits were huge, and they averaged about minus 15% for a 5 or 6 year period. It's just absolutely extraordinary. Huge budget deficit. If you're spending more money than you're taking in tax revenue, and you issue debt, then the national debt grows, and your debt to GDP ratio is increasing. It's increasing for two reasons. One, because we're issuing a ton of debt, and two, because GDP took a pretty major hit. So looking at this chart on the right, US debt to GDP, back in 1946, debt to GDP peaked in the post-World War, the first year after the war, at 119%. As I mentioned, we're at 109 right now, and we're going to 141 and maybe to 160, maybe. So what does that mean? Huge debt levels dampen growth and increase risk, so we need to find a way to reduce them. We are at the highest debt level since World War II and heading for the highest debt levels on record. So how does a government reduce levels of debt? And I'm going to take a few minutes and just walk through this theory of investing during an era of financial repression. You can only reduce debt in a couple different ways. You can grow your way out of it and service your debt. Fiscal adjustment, which means raising taxes or reducing government expenditures. Or you can default on your debt, and you can inflate it away, but if you try to inflate it away, if bond markets are efficient, then yields that are being demanded in the marketplace are going to adjust for the higher inflation. So the debt service on the big mountain of debt is going to be higher. So inflation by itself is not a good way to try and inflate, to reduce the debt levels. It's a good way if you can keep a cap on nominal interest rates. Capping nominal interest rates is called financial repression. So you combine these two things. You combine capping of nominal interest rates plus inflation, and you get debt liquidation. You can reduce the mountain of debt. It worked during the post-World War II period like a charm. In fact, let me just walk you through this. High debt levels dampen economic growth. You need to reduce them. Governments do need access to capital markets because, and your capital market access is dependent on your creditworthiness. Debt to GDP is the most common credit metric. It grows with budget deficits and declines with budget surpluses. We're going to see budget deficits for the foreseeable future. So you need to balance the budget to maintain stable debt metrics, but balancing the budget is politically difficult. Raising taxes, especially in an election year, is very hard. Taking away services, education, healthcare, police, those reducing expenditures, also very hard, but that's what you do to balance the budget. And all the while, you're making interest payments on debt. So you need to figure out a way to reduce debt without necessarily going through the pain of structural reform or adjustment or austerity. They're all the same thing. They're all balancing the budget. So what do? The government can implement policies of financial repression, and it's primarily driven by the Federal Reserve. What can the Fed do? The Fed can directly peg short-term interest rates at 0 and cap nominal interest rates. So they can also cap nominal rates out the curve. They can allow inflation to run hot. The Treasury can get involved with some regulatory help, and the commercial banking system would be pulled into service by being a captive buyer of treasuries through macroprudential policies. That is, the Treasury and the Federal Reserve can get together and say, commercial banking system, you need to improve your liquidity and liquidity risk profile and your reserve requirements. And to do that, that effectively means you need to buy more U.S. Treasuries. So the Fed and the Treasury create a captive market for Treasury securities. Let me just tell you what I think is going to happen. The policy timetable for financial repression is this. The Fed funds target rate is already capped at 0, at 12.5%, 12.5 basis points. 0 to 25 is the number. Quantitative easing has already done a pretty good job bringing rates down around the curve, but the Fed is going to announce in September, probably September, at the FOMC meeting, something called yield curve control. Quantitative easing isn't meant to cap yields. It is meant to provide liquidity and the smooth functioning of capital markets. Yield curve control is specifically designed to cap interest rates in the 3, 5, 10-year part of the yield curve. Japan is doing it now. They've done it since 2016. We did it in the U.S. in 1941 to 1951 or 2-ish before the Treasury Accord. So yield curve control is coming, and it will help promote financial repression. All that's left to do is to figure out a way for the Fed to allow inflation to run a little bit hot. And that's where average inflation targeting comes in. The Fed has been in a process for the last 18 months of reviewing its operating framework, and specifically the reaction function related to inflation. What I mean by that is, to date, the Fed has seen inflation get to 2%, and that worked as a trigger for them to raise interest rates. But after, I think, September, maybe October or November, when they announce average inflation targeting, it's going to allow the Fed to let inflation go to 2.2, 2.4% without raising interest rates. So inflation will run higher than it normally would under the Fed's old reaction function. It's not a trigger anymore. They're going to look at inflation over the course of a period of time. And by the way, if they have to look at inflation over the next, if they look back 3 years and forward 3 years, last 3 years, inflation's only averaged 1.7. So to get to the 2% target, they're going to have to let inflation run at average 2.3% for the next 3 years. Well, inflation's only at 1% right now. So it's going to have to rise dramatically for average inflation targeting to get us back to the 2% number. And I think that's what they're going to do. All the tools are already there. Or if they're not already there, they should be there shortly to implement financial repression. Let me conclude on a couple of slides. I include this one twice because it's so important. U.S. interest rates are in deeply negative territory, and that makes a 60-40 portfolio challenging. And I'll talk about that in a sec. The game plan for portfolios, and then I'll open it up to questions. What assets are attractive under these in this scenario? Well, there's opportunities still in credit markets, certainly more than there is in sovereign debt, with Treasury yields at 50 basis points, where credit, credit at least yields, high yield credit 5%, investment grade credit 2+%. 2+ doesn't sound inspiring until you compare it to 50 basis points for 10-year Treasuries and a negative real interest rate of about 100 basis points. So U.S. credit markets remain attractive. There's opportunities there. Obviously, if inflation's a problem, you should think about real assets, which include inflation protection bonds, Treasury inflation protection securities, and real estate. commodities and gold. Gold's had a great run already, so maybe that train has already left the station. But I think the trend can continue. The trend can continue as long as real interest rates continue to go negative. If real interest rates are negative, gold is hugely attractive, and investors are seeking alternative reserve currencies. That's why gold has done so well lately. So industrial, we're talking about zinc, aluminum, iron ore, or precious metals, both gold and silver, have all had great runs, up 15 to 25% in the last 3 months. And that should continue in an inflationary environment. So real assets are big. The last thing I'll mention is, given our outlook for inflation here in the US, non-US dollar assets are likely to do pretty well. Interest rate differentials between the US and our trading partners, particularly Japan and the Eurozone, have declined dramatically. The US dollar looks really good when our interest rates are higher, but our interest rates have come down so much that the interest rate differential is much lower now. So that doesn't provide the tailwind that the dollar's had. So the dollar's been declining. It's down 3 or 5% in the last 3 months. And that trend can also continue. And here's the most important thing. Find something that's uncorrelated, that is a structural risk premium that isn't correlated to public markets, rates markets, credit markets, or currency. Private investment vehicles can help you do that. So if it's possible to do so in your portfolio, being able to look at alternative investments that have structural risk premiums like liquidity risk premiums or asymmetric information risk premiums are very beneficial in this environment. The last point I want to make is financial repression and negative real interest rates do make for a more challenging investment environment. They pose specific challenges to portfolios that are heavily weighted to nominal bonds. As an example, if you have a significant nominal bond component in the portfolio, that may actually be a drag on performance going forward. It will still provide safety. It will still provide liquidity. So those are benefits that don't go away just because the investment return, the outlook for investment returns is a bit challenging. But at negative real interest rates, it's time to explore other opportunities and look maybe a little bit further afield. Talk to your financial advisor, talk to your consultants about these things. But financial repression, I think, is here to stay. It is the operating environment and framework that I anticipate for the next several quarters, if not years. And if it's like the historic period from 1941 until the early 1980s, it could last for decades. It could last for decades. With that, I'm going to try to look through the Q&A and see if there's any questions I can answer quickly. Otherwise, if you have a live question, I believe you can unmute and go ahead and ask me directly. I talked about gold and silver, Fed money printing, hyperinflation. I think I talked about that. We can continue to print money until there's a reserve currency. What did the betting markets say at this time in 2016? I can tell you what they said in the middle of August of 2016, precisely 85% chance for Hillary, 15 for Donald Trump. So yeah, I don't, I said it before, I'll say it again, there's 92 or 89 days between now and November 3rd, and everything can happen. And I don't necessarily believe the polls, but they are what we have. And by the way, whatever's in the polls is being priced into markets in one way or the other. So unless you get a big surprise, I expect that there will be a glide path in the stock market and other markets that are trading on the politics between now and then. It's not going to be November 4th is going to be up 20, down 20, because you'll know before we get there. But right now it's way too soon to tell. And your point is taken on the betting markets and polls. Where to go for investment income? Private credit I like. Fixed income seems low. Yeah, negative real rates. Private credit's good because it takes two of the themes or theses or the favorite asset classes, credit plus private, and rolls them into one. Presidential election slide. How accurate was your source in 2016? Did they predict a Trump win? Absolutely not. Nobody did in 2016, and I wouldn't bet on anything related to any election until we get well into November. So it's way too soon to tell. Jimmy Farrell says, if you pulled out the FANG stocks, what would the PE ratio be today? FANGs are, well above 30, and they make up 20% plus. So if 30% of the index is 20% plus, that's 6 points. So take 6 points out, Jimmy, plus or minus, probably something on the order of 20, if we're at 25 times, something closer to 18 or 19 times the 135. But you have to pull out the earnings for the FANGs too, which obviously isn't as much as, it doesn't have the same impact as pulling out their PE ratios on a market value weighted basis. but it wouldn't, it would look a lot better if you didn't. But having said that, the FANGs are stocks that are particularly favored in the current environment, given their technology weight and the fact that COVID-19 argues for large cap growth stocks, effectively call it the FANGs, just because they're favored industries. And a lot of those stocks are going to continue to do well in the stay-at-home market we find ourselves in. I am new to economic information. Is there good books to read? Yes. Anonymous attendee, if you send me an email on the out, I will actually, I can provide a bunch of different books on volatility, macro influences on capital markets, et cetera. Yes, I do see a weaker US dollar increasing gold prices, yes. With the volatility of the market and overvalued tech companies, would value stocks be a better option? I think ultimately, yes. I have not talked to any very, very, very impressive value investors, guys who've been doing it for 30 years, who think there's been a structural break in the relationship between growth and value. It's just that right now, value doesn't look so good because of the industries that make up value. So think banks. Banks in a flat yield curve, very low interest rate environment, they don't do that well. Real estate and REITs, it depends on what the underlying is. If it's industrial, multifamily, residential, good. If it's commercial property in gateway cities and downtown urban areas that command A prices, not so good. And we're already seeing some damage in those areas. Fortunately, our research, and Derek Newcomer, who runs our alternative investments group, who does a lot of research into private real estate investments, has been well onto that trend, and we've avoided commercial to a very great degree. And much of the real estate we offer is in multifamily, workforce housing, and also in industrial, which is where the money is going to be. Actual inflation remains low until there's activity, so expectations for actual are relatively no. So the reason I showed both actual and inflation expectations is actual inflation prints are what you're paying, and the expectations are, of course, what's being priced into the market into the future. And there's like a 92% R-squared correlation between expectations and actual inflation. It's really tight. So I just show them both because they're highly linked and correlated. Keeping interest rates low and letting inflation run hot is simply an alternative means of taxation. Yes, it is. It's generally regressive. Yes, it is. But it's also stealthy. And it's not an obvious form of taxation. It's a tax on saving, for sure. No question about it. Generally aggressive. Either way, a better approach would be controlling the pandemic and fiscal policy. Fiscal policy is creating the problem, though, insofar as fiscal policy creates high debt to GDP levels. And it needs to be liquidated through some policy of either default, growth. Growth is challenged with such high debt levels. So financial repression is the path of least resistance. Is a negative interest on its way in the near future? You must mean negative nominal interest rates. Yes, probably. The Fed won't do it on the policy rate. Negative Fed funds rates is not contemplated, but it's quite easy to see potential for negative 3-year yields. I mean, we're only at 12 basis points right now, and all it takes is increased demand. So if you get a hiccup in the economic recovery, a global growth scare, some kind of an exogenous shock, whether it's financial, terrorist, or something that causes a flight to quality, that flight to quality is going to go to short duration treasury securities. And there's just no freeboard between current level of nominal yields, call it between 10 and 25 basis points, and zero. You'll go to zero. There's no reason not to think that you couldn't. High yield munis right now, I think yes. I think there's an opportunity there. Different reserve currency that actually relates to how we are responding to this. Well, everyone else is doing much of the same thing. We're just doing more of it because we can. So again, I would expect our reserve currency to change without any real notice. No, you'll know. The reserve currency status will change because all of a sudden people will stop buying treasuries and interest rates will rise and there won't be enough Fed buying to do it. And that's when you go to phase 2, financial repression, and you start using macroprudential policy to make the commercial banks buy the debt. Inflation is a tax, no question. It's a regressive tax on savings and direct transfer of benefits from savers to borrowers, which in this case is the government. Is the current tax package likely to remain through 2025? No, probably not. Even if you get, even through 2025, even if the Senate and White House flip because of the 60% Senate rule. That's a hard question. The answer is it depends on the fiscal how things evolve fiscally. And no, I mean, if the more financial repression you do, the more you can spend money. So it depends. Sounds like you've just described the built-in push towards a change in reserve currency. I actually have. It is how you do it. So that's why we need to get debt under control quickly. And by the way, all the money printing can be viewed as an investment as well. If you're investing in a shorter downturn with less hysteresis, that is less people out of work for a long period of time, economic recovery will come faster, presumably. How do we get a recording? It'll be on the website. Check with Allie Warner at our shop. At what point has financial repression succeeded? Liquidated 100% of debt. At what point? Well, it took 35 years for debt to GDP in the US to go from 110% to 31% from 1946 to 1981. So it could take decades. Real estate, protection against financial repression, yes, because it responds positively to inflation. Asian equities compared to the US look pretty good. The recovery has been swifter in Asia and the growth rates are higher. Coming stagflation, I don't think necessarily, I don't believe we're going to do stagflation per se. It's going to be low growth and higher inflation, but stagflation argues for 5 to 10% inflation rates. We're going to be at 2 to 3%. Leveraging in real estate, yes, probably levering into real estate with interest rates really low and an inflation, high inflation beta asset, high beta asset in real estate, probably good. GDP ignores service. No, it does not. Is there a comparable indicator? No, it does not. GDP captures the domestic product across all aspects of the economic activity. We had a taper tantrum last time the Fed attempted to unwind. Do you believe the underlying fundamentals would allow them to unwind? No, I don't think it will be smooth, and I don't think it will happen anytime in the next 5 or 10 years, so we probably don't have to worry about it. Good idea to sell long-term cap gains this year for better tax rate. Don't know yet because the industry composition in long-term cap gains. Oh, I see, I'm sorry. Good idea to sell long-term cap gains this year for better tax rate. If you think rates are gonna go up, not necessarily, right? So let me think about that one. I don't know if capital gains taxes are gonna go up. They probably will. Emerging markets, okay in the long run, challenged in the short run because they can't deal with the virus as well as we have. They're fragile from a currency perspective, so they can't print money, they can't issue debt. So places like Turkey are getting whacked. Argentina has just announced a restructuring last week. Ecuador, Lebanon, lots of folks are restructuring their debt. Lebanon, of course, has even bigger difficulties now with that horrific explosion that occurred in the Beirut port yesterday. You know, sovereign debt outside the U.S. is, again, they're not the reserve currency. Do you expect a correction in stocks due to the recent run? I never, like a good economist, I don't put a number on it or a time frame. If I put a time frame on it, no number. Nobody can tell you what the stock market's going to do in the next 3 months. If they do, they don't know what they're talking about. Love to see those books. Okay, I'll make a list and I'll publish it on the website, a reading list. Would you invest conservatively in bonds or aggressives in stocks for the next year? Aggressively in bonds and conservatively in stocks. Many small businesses will be closed. Any impact on the larger economy? Yes. I mean, a lot of small businesses are going to be shut down. That's all incorporated in the GDP numbers I presented. What effect will financial repression have on the older fixed income investors? Well, you've benefited dramatically from a decline in nominal interest rates. If you owned any duration 2 years ago, 10-year yields were at 3%. Now they're at 50 basis points. So if you own 20-year bonds, you've had a 20-year bonds down 250 basis points. That's 25% to 30% kind of nominal return in long duration bonds. So you're happy. Problem is, once you get to the point where you've had a big capital gain, things get a little more challenging because the rate, your yield, your running yield, your current yield is much lower. So at a running yield of 50 basis points on 10-year treasuries, that's why I'm not a big fan of government debt. As geopolitical tensions increase, is there any possibility for China dumping U.S. treasuries? If they can find something else to own, yes. Again, it's all a relative game. But it does become more likely as tensions increase. But tensions are increasing now because of the campaign and the fact that we're in an election year. And it's a political winner to target China. China and the United States have a symbiotic relationship in many respects. They need us and we need them. Global cooperation and trade is always better. It improves outcomes, improves welfare, public welfare, domestically and internationally. So we should figure out a way to sort things out. We are the two biggest economies, and they're going to be bigger than us soon. Is it time to really invest in green? Yes, it is, probably. Turkey, Argentina, et cetera, aren't contestants as reserve currency. No, absolutely not. Too much vol. China or Euro are contenders, and compared to them, our response to the pandemic. Yes, I agree. Our pandemic response hasn't been as good as, surprisingly, China's, but they have a more authoritarian government. And that's a lot of the reason why. Euro has been horrible. Spain and Italy were the epicenters. The UK has had the worst per case, death per 100,000 residents. So not sure I agree necessarily with that. Continued 10,000 K limitations on SALT, yes. Or will Treasury Department view eliminating it as an opportunity to stimulate growth? No, it's more of a revenue generator. It's political. It's not all revenue. Presentation is good. Oh, thank you. China can invest in itself rather than our debt. It certainly can. And when it makes the transition from export-led growth and mercantilism to a consumer-led economy, which is in progress, then yes, they won't need us. That's true. You mentioned corporate earnings. What about corporate dividend yield outlook? Same, obviously, if they're can't have a dividend yield, they go hand in hand, right? Dividends are paid out of earnings. You said gold boat has sailed. I don't know if that's true. I don't think I said that. I think it has begun to sail. It may or may not be that the trend can persist as long as interest rates continue to go into negative real territory. I don't know if it's top. I would never say that a market is topped. I've been in this business way too long and have been made a fool of too many times to be able to call market tops or bottoms. We're investing for the long run here, and we're trying to see where the longer term trends are, and hence our views on financial repression, not on where the S&P is going to be in 90 days. Trump said the NASDAQ would crash if he was not reelected. What are my thoughts on that? I just said no one can predict the stock market, and I don't think the president can either. However, I'm always very interested to hear what everybody has to say. If there's additional comments, please do not hesitate to get in touch. I always want to hear what our clients are thinking about. If there's questions I didn't address that you'd like me to address, more than happy to do that as well. Get in touch with your consultant or your financial advisor, and I'll respond as soon as practical. And with that, we are about 10 minutes over, or 5 minutes over, given the start time. I want to say thank you to everybody for joining us on the Macro Markets Quarterly Update. I really enjoy putting these together, and I enjoy the ability to interact with our clients directly. Please don't hesitate to reach out if there was something else you'd want to talk about. A couple of upcoming events here on the screen. The next Macro Markets Quarterly Update will be during the first week of November. I look forward to speaking with you all before then, if not before. Thank you very much for joining.